Unit 9. Government-sponsored and other financing learning objectives. When you have completed this unit, you will be able to state the eligibility requirements for an FHA-insured, VA-guaranteed, and CalVet Home Loan. List the loan fees involved with the FHA-insured, VA-guaranteed, and CalVet Home Loan. Describe the forms of creative financing. Explain how the secondary mortgage market aids home buyers, and describe several ways in which the Economic Stimulus Act of 2008 helped home buyers. 272 Key terms. All-inclusive trust deed. 8. California Housing Finance Agency, CalHFA. California Veterans Farm and Home Purchase Program, CalVet. Certificate of Eligibility. Conforming loan, conventional loans. Creative financing, Department of Housing and Urban Development, HUD. Department of Veterans Affairs, VA. Direct Endorsement Plan. Discount points. Economic Stimulus Act of 2008. Electronic Signatures in Global and National Commerce Act. Fannie Mae, Farmer Mac. Federal Housing Administration, FHA. Federal Housing Finance Agency, FHFA. Freddie Mac. Ginnie Mae. Installment Sales Contract. Interest Rate Reduction Refinancing Loan, IRA. Land Contract. Leaseback. Mortgage-backed securities. Mortgage Insurance Premium. Overriding Trust Deed. Purchase Money Mortgage. Purchase Money Trust Deed. Sale Leaseback. Secondary Mortgage Market. Veterans Entitlement. Wraparound Mortgage. Wraparound Trust Deed. Summary. Non-conventional real estate loans include those insured by the Federal Housing Administration, FHA, or guaranteed by the Department of Veterans Affairs, VA. Through a variety of loan plans, these agencies use approved lenders to make lower interest, low down payment loans available for owner-occupied dwellings. Recent increases in FHA-insured loan limits should help home buyers in high-cost areas such as California. The California Veterans Farm and Home Purchase Program, CalVet, has for many years purchased and resold residences and farms to veterans. This self-supporting program is run by the California Department of Veterans Affairs, CDVA. In a time of expensive credit, seller financing through purchase money mortgages and trust deeds can be a boon. Sales or land contracts can be tricky but may be useful if undertaken with the proper legal advice. The wraparound mortgage, when allowed, can benefit both buyer and seller. The sale leaseback is a way to free up capital for a financially sound property owner. Fannie Mae has encouraged the growth of a strong secondary mortgage market by guaranteeing payment of interest and principal to holders of the mortgage-backed securities it creates by buying mortgages from lenders. Ginnie Mae guarantees securities issued by FHA-approved home mortgage lenders. Freddie Mac buys conventional residential mortgage loans for resale to investors and financial institutions. Increased limits on loans purchased by Fannie Mae and Freddie Mac should help homeowners in high-cost areas such as California, who can now qualify for conforming loan interest rates. Fannie and Freddie are now under the conservatorship of the Federal Housing Finance Agency. California_principles_10e_book.in 292 the 23rd of May 2017 2:30 and 37 seconds p.m. Unit 9 Government-sponsored and other financing 293 Open for discussion. Once property is encumbered by debt, it becomes much more difficult to transfer title. One way to simplify real estate transactions would be to have a loan stay with the borrower, with the security interest transferred to the borrower's next property, assuming that the borrower purchases property equal to or greater in value than the property sold. 1. What do you think of this concept? California_e_principles_10e_book.in 293 the 23rd of May 2017 2:30 and 37 seconds p.m. 294 California Real Estate Principles 10th edition review questions 1. A California veteran might have a home loan insured by A. FHA, B. VA, C. CalVet, D. Fannie Mae. 2. FHA appraisal value is used to set the upper limit of A. The purchase price, B. The loan amount, C. The construction cost, D. The seller contributions. 3. In addition to a monthly charge, FHA mortgage insurance includes a one-time payment on a purchase loan that is a 1.75% of the loan amount. B. Variable. C. Negotiable. D. Determined by the lender. 4. For an existing structure, the maximum FHA mortgage loan term is a 15 years and 32 days. B. 25 years. C. 30 years. D. 40 years. 5. One discount point will increase a lender's effective yield by approximately a 1.4%, B. 1.8%, C. 1.82%, D. 1%. 6. 4 discount points will increase a lender's effective yield by approximately a 1.4%, B. 1.8%, C. 1.82%, D. 4%. 7. On FHA loans, seller contributions, including discounts and closing costs, cannot exceed a $5,000, B. 4%, C. 5 points, D. 6% of acquisition cost. 8. 5 different graduated payment mortgages are approved by a FHA, B. VA, C. GalVet, D. Ginnie Mae. 9. A veteran can have a home loan guaranteed by a FHA, B. VA, C. GalVet, D. Fannie Mae. 10. The notice of value sets the upper limit of value for a. The purchase price, B. The loan, C. The guarantee, D. None of the above. 11. Using the benefits of the GI Bill, a veteran cannot buy a house, B. A condominium, C. A farm, D. A manufactured home. 12. A veteran can be given a home loan on property owned by a FHA, B. VA, C. GalVet, D. Fannie Mae. 13. A CalVet purchase loan must be applied for a. Within 1 year of property purchase, B. Before closing, C. Before a contract of sale is signed, D. Before talking to a property seller. California_E_principles_10E_book.inp 294 the 23rd of May 2017 2:30 and 37 seconds p.m. Unit 9 Government Sponsored and Other Financing 295. 14. CalVet loans are not available for a. Single-family homes, B. Manufactured homes, C. Working farms, D. Commercial property. 15. Many seller-financed purchases are examples of a. Institutional lending, B. Creative financing, C. Mortgage-backed securities, D. Blended rate mortgages. 16. An installment sales contract also is called a GEM, B. A GPM, C. A land contract, D. A bill of sale. 17. In a sale leaseback, a. Land is never sold, B. Buildings are always sold, C. Both land and buildings can be sold, D. Only a leasehold interest is sold. 18. The secondary mortgage market does not deal in a. Primary mortgage market instruments, B. Junior liens, C. Issuing loans, D. Mortgage-backed securities. 19. Which is not a part of the primary mortgage market, a. FHA, B. VAC, CalVet, D. Fannie Mae. 20. Ginnie Mae securities are not backed by a. FHA insured loans, B. VA guaranteed loans, C. Farmer Mac guaranteed loans, D. CalVet loans. Government-sponsored financing. Loans that do not involve government cooperation are called conventional loans. Loans that are created or financed with the help of a government source are non-conventional loans, and they are the focus of this unit. Both federal and state programs are discussed. Federal Housing Administration. The National Housing Act was passed in 1934 in response to the numerous foreclosures brought about by the Depression and has been amended many times since. One of the agencies created by the National Housing Act was the Federal Housing Administration, FHA, a division of the Department of Housing and Urban Development, HUD. FHA does not make loans, but it insures loans made by lending institutions such as thrifts, banks, life insurance companies, mortgage companies, and others. For 60 years, FHA has been a major force in determining how lending practices are carried out. Information about HUD and FHA programs can be found at www.hud.gov, www.fha.com, or by calling 1-800-CALL-FHA. The HOPE hotline, 1-888-995-HOPE or www.995hope.org, provides free mortgage counseling in English and other languages, 24 hours a day, 7 days a week. Section 203 of Title II of the National Housing Act specifies eligibility requirements for federal mortgage insurance for housing construction and finance. Section 203b covers mortgages on 1 to 4 family homes. Section www.hud.gov, www.fha.com, www.995hope.org. California_E_principles_10E_book.in 272 the 23rd of May 2017 2:30 and 35 seconds p.m. Unit 9 Government Sponsored and Other Financing 203K covers loans for property renovation. FHA insures approximately 7 million loans valued at almost $400 billion through this and its other programs. FHA insured loan limits. Insured loan amounts are adjusted annually to reflect changes to the maximum amount allowed for loans that are held or backed by the organizations, such as Fannie Mae and Freddie Mac, which comprise the secondary mortgage market, discussed later in this unit. FHA insured loan limits are set at 65% to 150% of the limit for loans purchased on the secondary market, with the higher loan limits available for higher cost areas. For 2017, the maximum FHA insured loan on a California single-family home ranged from $275,665 to $636,150, as shown in Figure 9.1. The maximum also is higher for property in Alaska, Hawaii, Guam, and the U.S. Virgin Islands. The selling price of a home can be higher than the maximum amount stated, but FHA insurance will not cover the excess. Condominium loan limits are approximately the same as those for single-family residences in the same county. Higher limits apply to 2 to 4 unit properties. Current loan limits can be found at www.fha.com/lending_limits_state. State equals California. Legislation raising FHA loan limits created the FHA Forward program. FHA also has the Home Equity Conversion Mortgage, HECM, a reverse mortgage program for homeowners age 62 or older, and loans available through the Hope for Homeowners program, a refinancing plan for homeowners having difficulty making mortgage payments but who can afford a new FHA-insured loan. Total cash investment. The minimum cash investment made by a borrower on an FHA-insured loan must be at least 3.5% of the sales price, provided the borrower has a credit score of at least 580. If the borrower has a credit score of 500 to 579, the required down payment is 10%. Although other factors, such as late payments on existing debts, may result in denial of the loan application by FHA, a borrower with a credit score of less than 500 is ineligible for FHA-insured financing. Mortgage insurance premium and monthly fee. FHA-insured loans have both an upfront mortgage insurance premium, MIP, that is paid to FHA at closing as well as an annual renewal fee, which is paid on a monthly basis. The upfront MIP is not considered an acquisition cost of a loan in computing down payment. The premium may be paid by the borrower or someone else, or it may be included in the loan amount. Presently, the FHA MIP is 1.75% of the loan amount for all purchase loans and 2% for home equity loans. The MIP is refunded if a loan is prepaid, paid in full before the end of the loan term. Figure 9.1. FHA loan limits for 2017. The annual insurance charge, which is paid in monthly increments, depends on the loan amount, loan term, and the loan-to-value ratio, LTV. The following table shows the current annual MIP rates by amortization term, base loan amount and loan-to-value, LTV, ratio. These MIP amounts became effective for FHA loans originated on or after January 26, 2015. Rates will remain in effect until and unless revised by FHA as authorized by Congress. FHA insurance may be cancelled for loans originated after January 1, 2001, for loans that originated before June 3, 2013. The FHA monthly mortgage insurance payments automatically terminate when one of these conditions is met. A. If the mortgage term is 15 years or less and the loan-to-value ratio was 90% at the time of origination, the annual premium will be cancelled when their California_E_principles_10E_book.in 275 the 23rd of May 2017 2:30 and 36 seconds p.m. 276 California Real Estate Principles 10th edition. Loan-to-value ratio reaches 78%. Regardless of the amount of time the borrower has paid the premiums. If the mortgage term is more than 15 years, the annual premium will be cancelled when the loan-to-value ratio reaches 78%, provided the borrower has paid the annual premium for at least 5 years. For loans that originated on June 3, 2013, or later, the following apply. If the original mortgage term was 15 years or less and the original LTV was 78% or less, the mortgage insurance premium will be terminated after 11 years. If the original LTV was greater than 90%, the mortgage insurance premium will continue for the loan term. If the original loan term was greater than 15 years and the original LTV was not greater than 90%, the mortgage insurance premium will be terminated after 11 years. If the original LTV was greater than 90%, the mortgage insurance premium will continue for the loan term. Interest rate and loan term. The interest rate may rise or fall with prevailing market rates. The loan term may not be longer than 35 years if the loan is approved before construction, or 30 years otherwise. The 30-year term has been the most popular with lenders and borrowers, but shorter-term loans are beginning to gain favor. Generally, loans must be fully amortized in equal monthly payments that include both principal and interest. Monthly payments also include impounds for taxes, special assessments, and fire or other hazard insurance. Prepayment penalty. FHA-insured loans have no prepayment penalties. Points. A lender can charge discount points, prepaid interest, to the borrower in addition to the 1% loan fee. Discount points are the lender's way of increasing loan income while keeping the interest rate at a competitive level. 1 discount point equals 1 percentage point of the loan amount. Discount points are paid at closing by the borrower or someone else. Usually the seller pays discount points to increase the lender's effective yield, even though the borrower may be offered a lower than market interest rate. On loans of the same amount and term, 1 discount point increases the overall yield on a loan by approximately 1/8%. Thus, a loan at 7% and 3 discount points effectively earns 73/8% for the lender. For example, Joe is selling his single-family residence in Solano County. Harold Maloney and Barbara Clark have offered $159,000. Contingent on their securing FHA-insured financing. Joe accepts the offer. A lender approached by Maloney and Clark is willing to make a loan of the maximum FHA-insurable amount of $151,725, to carry an interest rate of 71.82%, with 2 discount points to be paid at closing, when the loan is funded. What is the amount of the discount points, and who will pay them? The discount points are valued at $3,035, $151,725 A-2%, and are payable as stipulated in the agreement between the buyers and Joe. 1 discount point is 1% of the loan amount paid up front. California_E_principles_10E_book.in 276 the 23rd of May 2017 2:30 and 36 seconds p.m. Unit 9 Government-sponsored and other financing. 277 discount points are a matter for negotiation between buyer and seller. Regardless of who pays, the contract of sale should stipulate who will pay and set a limit on the number of discount points that will be paid. Seller-funded down payment assistance programs effective October 1, 2008, FHA prohibits the use of down payment assistance programs funded by those who have a financial interest in the sale, such as the property seller. Programs provided by non-profits or funded by other sources, such as churches, employers, or family members, are still allowed. Allowable seller concessions, such as payment of discount points, cannot exceed 6% of the home purchase price. Types of loans available: in addition to the traditional fixed-rate amortized loan, FHA allows use of a graduated payment mortgage, GPM. The GPM is available for families who expect income to increase over the loan term and who otherwise would not qualify for a mortgage loan. Only single-family residences are eligible. With a GPM, monthly payments do not cover all of the interest due. The unpaid interest is added to the remaining balance of principal owed. This negative amortization process continues for 5 to 10 years, depending on which of 5 different GPM plans is used. At that point, monthly payments stay the same to their end of the loan term and are fully amortized. Because interest is paid on interest, the statute specifically preempts any state usury laws that might be violated. FHA allows an adjustable rate mortgage, ARM, for owner-occupied residences of no more than 4 units. The rate of interest charged is adjusted by increases in monthly payment, outstanding principal balance, loan term, or a combination of the three. Maximum loan term is 40 years. Adjustment of the interest rate must correspond to a specified national interest rate index. Adjustments of no more than 1% of the outstanding loan balance may be made annually, with an increase of no more than 5% over the initial contract interest rate over the life of the loan. At the time of application, the borrower must be given a written explanation of the loan features and possible rate and payment increases over the loan term. FHA also allows a shared appreciation mortgage, SAM, for a dwelling of 1 to 4 units. By a qualification for an FHA loan, the following rules are aimed at reducing the number of defaults on FHA-insured loans, in addition to preventing defaulting borrowers from acquiring more credit. Total seller contributions, including discounts, buy-down costs, and closing costs, cannot exceed 6% of acquisition cost. The borrower must be qualified at the full note rate, rather than the buy-down rate. The borrower's social security number must be supplied on the loan application to assist in reporting of delinquent and foreclosed loans to other federal agencies and to credit bureaus. HUD Direct Endorsement Plan. Under HUD's Direct Endorsement Plan, qualified lenders may process a loan without prior HUD review, except for construction projects. This program thus eliminates the lengthy processing time that is one of the major drawbacks of the federally insured loan. California_E_principles_10E_book.in 277 the 23rd of May 2017 2:30 and 36 seconds p.m. 278 California Real Estate Principles 10th edition. National Housing Trust Fund. The Housing and Economic Recovery Act of 2008, HERA, created the National Housing Trust Fund, NHTF, to be funded by a percentage of profits from the government-sponsored enterprises mentioned later in this unit. The NHTF is intended to provide revenue to communities to build, preserve, and rehabilitate affordable rental homes for extremely and very low-income households. The first state allocations, to be made in 2016, total $173.6 million. California's allocation is $10,128,143, to be administered by the California Department of Housing and Community Development. More information on NHTF is at www.nlg.org/issues/NHTF. Department of Veterans Affairs. The Servicey Members Readjustment Act of 1944, the GI Bill of Rights, helped ease the transition into civilian life of World War II veterans. The programs later were expanded to include veterans of subsequent conflicts. The GI Bill also covers the surviving spouse of an eligible person who died as the result of a service-connected injury, and the surviving spouse of a person missing in action or listed as a prisoner of war for more than 90 days. Benefits are available as long as the surviving spouse remains unmarried. Information on the GI Bill is at www.gibill.va.gov. The Department of Veterans Affairs, VA, presently authorizes first mortgage loans as well as second mortgage loans of less than 40% of property value. The VA guarantees payment of the remaining mortgage indebtedness, up to a maximum amount. If the borrower defaults, the VA will pay the lender's net loss up to the amount of the guarantee, which is decreased proportionately as the loan amount is repaid. There is no cost to the borrower for the VA guarantee. The VA also makes loans to veterans directly in areas where there are few mortgage lenders. Because of the abundance of financing sources in this state, there are no direct VA loans to veterans in California. Borrower qualifications: VA guaranteed loans are available to those men and women who served in the U.S. Armed Forces and were other than dishonorably discharged, and to their spouses, as mentioned above. The period of active duty required varies, depending on the date of service, 90 days during wartime and 181 days otherwise for those who served up to September 7, 1980, enlisted, or October 16, 1981, officer. Veterans who served after those dates must have completed 24 months of continuous active duty or the full period, at least 181 days, for which they were called to duty, or have been discharged for a service-connected disability, or in certain other cases, veterans with service during their Gulf War period and subsequent conflicts, August 2, 1990, to a date yet to be determined, must have completed 24 months of continuous active duty or the full period, at least 90 days, for which they were called to active duty or have been discharged for a service-connected disability, or in certain other cases. Lending institutions are able to screen VA loan applicants for eligibility as part of the loan qualification process. Supervised lenders verify the veteran's entitlement, then process the loan as usual. There is no need for VA review and approval. 279 An interested veteran should request a certificate of eligibility from the nearest VA regional office in advance of loan application. The certificate will indicate the amount of loan guarantee, called the veteran's entitlement, available to the veteran. If VA records indicate sufficient data on the veteran, an automated certificate of eligibility, ACE, can be obtained by a lender using the Internet, and their certificate will be issued online within a few seconds. The Native American Direct Loan (NADL) program helps Native American veterans purchase, construct, improve, or refinance a home on Native American trust lands. The veteran's tribal organization must participate in the VA Direct Loan program, and the veteran must have a valid certificate of eligibility. Loan guarantee amount: VA guaranteed loans can be made for purchase, construction, repair, or improvement of a veteran's dwelling, which can be a building of 1 to 4 units or a condominium. The basic veteran's entitlement is $36,000. For loans in excess of $144,000 to purchase or construct a home, the entitlement is up to 25% of the loan limit set by the VA for a single-family home. In California, for loans closed in the calendar year 2016, the limit ranges from $417,000 up to $1,202,925 for a 4-unit dwelling, based on the median sales price of the county. For 2017, the limit ranges from $431,250 to $636,150 for a single-family home, with corresponding increases on 2 to 4 unit dwellings. The VA makes a specially adapted housing (SAR), or Special Housing Adaptation (SHA), grant available to service people and veterans with certain total and permanent disabilities related to their military service. The maximum amount allowable for an SAR grant in 2016 is $73,768. The maximum amount allowable for an SHA grant in 2016 is $14,754. The maximum is subject to adjustment upward annually based on a cost of construction index. No individual may use the grant benefit more than 3 times, up to the maximum amount. Restoration of entitlement. The amount of a veteran's entitlement can be restored once, if the veteran refinances a VA loan with a conventional loan. The veteran's entitlement is increased to the full amount if the property is disposed of and a VA guaranteed loan is paid in full. The VA is released from liability on the original loan. Any loss suffered by the VA has been repaid in full, or the property is transferred to another veteran who is entitled to VA home loan guarantee benefits. There must be a release from personal liability to the government on a VA loan before an assumption of the loan by a purchaser of the property. Otherwise, the veteran remains liable under the original terms of the guarantee. Such release should be a condition of the sale, specified in the contract. If the property is foreclosed and there has been no act of fraud, misrepresentation, or bad faith by the veteran, the VA can release the veteran from further liability. The certificate of eligibility shows the veteran's entitlement. California_E_principles_10E_book.in 279 the 23rd of May 2017 2:30 and 36 seconds p.m. 280 California Real Estate Principles 10th edition. Notice of value. The lender will request a determination of reasonable value from one of a panel of VA recommended appraisers, who will provide a notice of value, NOV, formerly called a certificate of reasonable value, for the subject property. The veteran must be given a copy of the NOV before signing a contract of sale, or the contract should include a contingency that the veteran be able to either affirm or withdraw from the transaction without penalty if the NOV value is less than the purchase price. Types of loans available. Veterans have had a choice of 4 payment plans. A fixed term is a fully amortized mortgage for up to 30 years and 32 days. A adjustable rate mortgage, ARM, is similar to the FHA program but based on the Treasury Securities Index on loans initiated before October 1, 1995. These loans are no longer available. A growing equity mortgage, GEM, is tied to an index and results in increases in payments with the increases applied to the principal balance. The GEM is a formalized way of making additional principal payments, which increases the accumulation of equity and shortens the overall loan term. A graduated payment mortgage, GPM, provides for lower initial monthly payments, increasing at a rate of 7% annually for the first 5 years. From their 6th year to the end of the loan term, the payments remain the same. Unlike FHA, which allows for other variations of the GPM, the VA allows only this one form of graduated payment. Some restrictions apply on manufactured home loans. The manufactured home must be at least 40 feet long and 10 feet wide, with a minimum of 400 square feet, and installed on a permanent foundation. The maximum loan term for the purchase of a single wide manufactured home, with or without a lot, is 15 years and 32 days. The maximum loan term for the purchase of a double-wide manufactured home, with or without a lot, is 20 years and 32 days. Interest rate. The VA now allows borrowers to negotiate the interest rate on a VA guaranteed loan with the lender. Down payment and closing costs. As long as the estimate of reasonable value does not exceed the amount of the VA loan guarantee, the VA does not require a down payment, although the lender may. The VA loan guarantee can never be more than the estimate of reasonable value, but a higher purchase price may be negotiated if the veteran pays the difference between the reasonable value and the purchase price in cash at the closing. The cash must come from the personal resources of the veteran and not from secondary financing. On the first use of a VA guaranteed loan with a down payment of less than 5%, a funding fee of 2.15% of the loan amount is charged, 2.4% for veterans of the Reserves or National Guard, on loans closed on or after November 22, 2011, through September 29, 2024. With a down payment of at least 5% but less than 10%, the fee is 1.50%, or 1.75%. With a down payment of 10% or more, the fee is reduced to 1.25%, or 1.50%. Subsequent use of a VA guaranteed loan carries a higher funding fee, presently 3.3% for all veterans making a down payment of less than offsets the maximum loan amount the VA will guarantee. California_E_Principles_10E_book.INP 280 the 23rd of May 2017 2:30 and 36 seconds p.m. Unit 9 Government sponsored and other financing 281 than 5%, 1.5%, or 1.75%, with a down payment of at least 5% but less than 10%, and 1.25%, or 1.5%, with a down payment of 10% or more. There is a funding fee of 1% for all manufactured home loans. The veteran can pay discount points, which are subject to negotiation with the lender. Veterans are permitted to finance discount points. Refinancing an existing VA loan can be refinanced with a VA guaranteed interest rate reduction refinance loan, IRR. The reasons for the refinancing, which must be acceptable to the lender, can include repairs or improvements to the property or providing the veteran with funds for educational purposes. A veteran can refinance an existing VA loan if the new loan will carry a lower interest rate. The amount refinanced cannot exceed the remaining balance of the existing loan plus allowable closing costs, which may include discount points. The amount financed cannot be greater than the original amount guaranteed, and the overall loan term must remain the same. No additional amount will be charged against the veteran's entitlement. On a refinancing loan, the funding fee is 5% in all cases. Loan servicing. The VA is available to help a veteran even after a loan is secured if the veteran is having a problem making loan payments. If a loan is delinquent 3 months, a notice of default alerts the VA to the situation. Financial counseling is provided to help the veteran pay arrearages and avoid future missed payments. FHA versus VA loans. At present, there are fewer distinctions between FHA insured and VA guaranteed loans than there have been in the past. The differences that still exist involve the following factors. Loan purpose. Both FHA insured and VA guaranteed loans are available for first mortgages of owner-occupied property. VA loans also include junior liens for repairs or improvements. Although FHA technically allows some types of secondary financing, for all practical purposes the FHA market is first mortgages only. Loan amount. VA guarantee limits do not set the upper limit of the loan amount. FHA loan maximums are exactly that. Interest rate. Both VA and FHA allow lenders and borrowers to negotiate the interest rate offered, which can vary from lender to lender. Both FHA and VA allow a variety of loan types. Down payment. VA generally does not require a down payment, although the lender may. FHA requires a down payment of at least 3.5% of the sales price or appraised value, whichever is less. Down payment and closing costs usually are lower on a VA guaranteed loan than on an FHA insured loan. California_E_Principles_10E_book.INP 281 the 23rd of May 2017 2:30 and 36 seconds p.m. 282 California Real Estate Principles 10th edition. Service charges. FHA allows a service charge of 1% on loans involving existing buildings and 2% on loans for buildings to be constructed. Buyers can be charged discount points, which are a subject for buyer-seller negotiation. Seller contributions cannot be more than 6% of acquisition cost as of March 2012. The buyer also can be charged an FHA application fee and fees for credit report, appraisal, and other closing costs. VA allows lenders to charge reasonable costs, including credit report, survey, title evidence, and recording fees. The VA does not have a charge for mortgage insurance, but loan origination costs can be included in a flat charge that cannot exceed 1% of the loan amount for most properties. In certain cases, the veteran may be charged discount points. The VA funding fee depends on the down payment and origination date. Loan prepayment. Both agencies allow full or partial prepayment of principal at any time. The VA does require that any prepayment be at least $100 or their amount of one installment. Refinancing to avoid default. Both FHA and VA loans can be refinanced to avoid imminent default. so that payments may be extended beyond the initial loan term. VA loans can be refinanced only if 80% or more of the new loan will be paid within the original loan term limit. The FHA loan term on refinancing can be no more than 3/4 of the remaining economic life of the building. HERA has provided a refinancing program for home buyers with problematic subprime loans, allowing lenders to write down qualified mortgages to 90% of current appraised value and providing qualified borrowers a new FHA 30-year fixed-rate mortgage at 90% of appraised value, up to a maximum loan amount of $550,440. Borrowers share 50% of all future appreciation with FHA. The Helping Families Save Their Homes Act, which was signed into law by President Obama on May 20, 2009, gives FHA more enforcement capabilities against lenders who use false or misleading marketing tactics. RISPA Note 1 Final similarity between FHA-insured and VA-guaranteed loans. Because both are federally related, both fall within the requirements of the Real Estate Settlement Procedures Act, RISPA, discussed in Unit 8. In addition to all other disclosure requirements, a HUD settlement statement noting transaction charges for both buyer and seller appears in Unit 10. California Veterans Farm and Home Purchase Program. The California Veterans Farm and Home Purchase Program, CalVET, was created in 1921 to assist California veterans in acquiring home or farm property. The program is included in Division 4, Unit 6, of the Military and Veterans Code. CalVET loans are administered by the California Department of Veterans Affairs, CDVA, found at www.cdva.car.gov. CDVA authorizes, processes, funds, and services the loans. No outside lenders are involved, because the program is totally www.cdva.car.gov. California_E_principles_10E_book.int 282 the 23rd of May 2017 2:30 and 36 seconds p.m. Unit 9 Government sponsored and other financing 283 self-supporting. Funds for CalVET loans come from voter-approved state general obligation bonds and revenue bonds issued by the legislature. CDVA buys the selected property from the seller and resells the property to the veteran on a land contract, explained later in this unit. CDVA holds title until the veteran has repaid the amount owed, although the veteran has the right to possession of the property as his personal residence. CalVET loans can be used to purchase an existing home, finance a lot purchase and new construction, rehabilitate a home purchased as is, and make home improvements. All properties purchased with a CalVET contract, except for mobile homes and condominiums, are covered under the Fire and Hazard Insurance Program. In addition, a master disaster indemnity policy provides insurance coverage for losses due to flood and earthquake. Eligibility requirements. CalVET loans are available to most veterans planning to buy a home in California. Prior or current California residency is no longer a requirement. CalVET loans are available to any veteran who has served a minimum of 90 days on active duty, not including active duty for training purposes only, or was discharged due to a service-connected disability, or is eligible to receive a U.S. Campaign or Expeditionary Medal, or was called to active duty from the Reserves or National Guard due to a presidential executive order. CalVET loans are available to currently active duty personnel. The applicant or a member of the applicant's immediate family must occupy the home within 60 days of close of escrow and continue to occupy the home until the loan is paid in full. A current member of the Reserves or California National Guard who has served a minimum of 1 year of a 6-year obligation is also eligible, provided the applicant is a first-time home buyer or purchases a property located in a targeted area. In some instances, unremarried spouses of veterans are also eligible. If funds are in short supply, which is not usually the case, preference will be given to wounded or disabled veterans, then former prisoners of war and unremarried spouses of those missing in action or prisoners of war, then Vietnam-era veterans and Native American veterans applying for loans on reservation or trust land. then all other eligible veterans, qualifying loan application must be made before purchase. The veteran must meet ordinary standards of creditworthiness, interest rate and loan term. The loan term is always 30 years, but prepayment of principal can be made at any time, which can shorten the loan term. The interest rate on all loans may change annually, depending on the cost of bonds to fund the program. Monthly loan installments will increase to cover additional interest charges. CDVA offers 3 funding, interest rate programs. A veteran's eligibility for each program may vary based on income or purchase price limits, prior home ownership, and wartime service. The rates posted for these programs for 2016 for a 30-year loan are a 5.5%/5.71% APR, with an additional 1% added for loans on mobile homes in parks, for loans made from unrestricted funds, with wartime service not required, and the veteran must apply within 25 years of release from active duty. A 3.5%/3.69% APR, 3%/3.26% APR for a 20-year term, for loans made from qualified veterans' mortgage bonds, with wartime service required, and the veteran must apply within 25 years of release from active duty. And a 3.45%/3.64% APR for loans made from qualified mortgage bonds subject to income and purchase price limits but with no wartime service requirement. There is a 0.5% cap on increases during the term of the loan. The APR is based on a $200,000 sales price, 10% down payment, financing the VA funding fee under the CalVet, VA loan program, and a 1-year premium for disaster insurance. Prepayment. CalVet loans may be prepaid at any time without penalty. Loan amount, down payment. The maximum CalVet loan amount, minimum down payment, and loan fees are shown in Figure 9.2. The maximum CalVet loan amount for 2016 varies by county and is 125% of the maximum Fannie Mae loan limit, 150% for farm loans. A home improvement loan can be made for up to $150,000. Change of residence. A veteran can obtain a new CalVet loan as long as the first loan is paid in full or awarded in a divorce to a non-veteran spouse. As with all government loan programs, CalVet loan requirements are subject to change at any time. Anyone interested in such a loan should contact the closest office of the California Department of Veterans Affairs via the website or telephone. Mortgage assistance. The California Military Families Financial Relief Act allows for the deferral of mortgage payments secured by the principal residence of a member of the Reserves or National Guard who is called to active duty. The loan does not have to be a CalVet loan. Figure 9.2. CalVet loan programs. California Housing Finance Agency. The California Housing Finance Agency, CalHFA, was chartered in 1975 as a self-supported affordable housing bank to make low-interest loans funded by the sale of tax-exempt bonds. CalHFA bonds are repaid by mortgage loan revenue. The CalHFA conventional loan program offers a fully amortized 30-year fixed-rate first mortgage loan. As an added benefit, the CalHFA loan can be combined with either the My Home Assistance Program, My Home, or the Extra Credit Teacher Program, ECTP. Information on current CalHFA borrower requirements and loan programs can be found at www.calfa.car.gov. Exercise 9.1. Refer to the information discussed in this unit to answer the following questions. 1. Could the same individual be eligible for an FHA, a VA, and a CalVet loan? www.calfa.car.gov. California_E_principles_10E_book.inp 285 the 23rd of May 2017 2:30 and 36 seconds p.m. 286 California Real Estate Principles 10th edition. 2. Mary Smith is eligible for a CalVet loan and would like to make the minimum down payment. What will be the maximum loan amount that she will be allowed? 3. Is a borrower's down payment likely to be lower with an FHA insured or a VA guaranteed loan? Creative financing. When interest rates are high, there is an oversupply of properties for sale, or rising prices make housing less affordable, Sellers frequently help to finance property purchases. Seller financing and other techniques can bring down the effective interest rate paid by buyers and make property purchases more attractive. Some of those creative financing techniques are discussed next. Purchase money trust deeds and mortgages. The purchase money trust deed or purchase money mortgage is given by buyer to seller at the time of purchase to secure all or part of the purchase price. The purchase money may come from either a third party, such as an institutional lender, or in the form of credit from the seller. Typically, the seller who is willing to carry back, a purchase money mortgage or trust deed will set a rate lower than market interest to attract a greater number of qualified buyers without having to reduce the selling price drastically. The concept of seller financing certainly is not new, and it has been used to a considerable extent in California. The seller can finance a first or second mortgage or deed of trust. Without the availability of the seller-financed second, many buyers would lack sufficient funds for the ever-increasing down payments necessitated by rising property values. Land contract. The land contract, also referred to as a contract for deed or installment sales contract, should not be confused with what we have referred to as the contract of sale between the parties. A land contract is a form of seller financing in which the buyer takes possession of property and makes payments on its purchase but does not receive legal title to the property for at least 1 year from the date of possession. The sales contract specifies the amount of the purchase price that must be paid before legal title is conveyed. A land contract is one alternative for a buyer who does not qualify for a regular mortgage loan. A land contract usually requires little or no down payment. The buyer takes possession of the property but, because the seller retains title, it may be less risky for the seller than other forms of financing. The seller cannot automatically eliminate the buyer's interest on default. However, courts and legislature have rejected harsh remedies that could prevent a defaulting buyer from realizing any buildup. A land contract appeals to people who don't want to deal with a bank or other institutional lender, or who may have difficulty qualifying for a loan. California_E_principles_10E_book.in 286 the 23rd of May 2017 2:30 and 37 seconds p.m. Unit 9 Government sponsored and other financing 287 of equity in the property. The land contract also must follow strict notice and other requirements. Any seller contemplating such a sale should not do so without first consulting an attorney to ensure that all legal requirements are met. Wraparound mortgage or trust deed. The wraparound mortgage or wraparound trust deed is also called an overriding trust deed or all-inclusive trust deed. 8. An 8 is a way to take advantage of a seller's existing loan with a relatively low rate of interest. The existing loan is unchanged, but the buyer receives additional funds, using the property as collateral, to make the purchase, and the lender of those new funds receives payment sufficient to cover both old and new loans. The new loan wraps around the existing loan. The advantage to the buyer is that an overall less than market rate of interest is paid on the new loan balance. The lender benefits by receiving interest based on the entire loan balance at a rate higher than the original loan rate. The lender not only earns interest on the additional loan amount but may keep the excess earned at the new rate on the old balance as well. A buyer could give a wraparound trust deed or mortgage to a seller, who then would make payments on the first loan. It is important to note that a wraparound loan is possible only if the original loan documents permit such a refinancing. An alienation clause in the original loan documents would prevent a sale under such terms. An attorney should be consulted before entering into any such transaction. For example, present market interest rate on a home mortgage loan of $100,000 is 6%. A money market account earns 1.5%. The seller of Greenocker will hold a wraparound mortgage on his home priced at $100,000, with $20,000 down, for 20 years, at only 5% interest. The seller has an existing mortgage loan balance of $50,000 at 6% interest for 20 years. On those terms, what will be the rate of return to the seller on his remaining equity? The seller receives $20,000 immediately, leaving an equity interest in the property of $30,000. The seller is owed yearly interest of 5% on $80,000, or $4,000, and owes 6% on $50,000, or $3,000. The seller's yearly return is thus $1,000, $4,000 a $3,000. That return divided by the amount invested, $30,000, indicates a rate of return of 3.33%. The buyer benefits from a lower than market interest rate, and the seller benefits from a return that is higher than the prevailing money market rate. Sale-leaseback. The sale-leaseback, or just leaseback, is a method of property transfer. It is mentioned here because it is a useful way for a financially sound but cash-poor business to gain needed capital while keeping office or other space. By selling property it owns and uses, a business gets cash. By leasing the same space back from the buyer, the business can deduct the entire lease payment from. A wraparound mortgage makes sense only when interest rates are rising. California_E_principles_10E_book.int 287 the 23rd of May 2017 2:30 and 37 seconds p.m. 288 California Real Estate Principles 10th edition. Income. Not all of the property need be sold or the land alone could be sold for the same tax reasons, but buildings on the land could be kept for depreciation deductions. The buyer in a leaseback benefits by the typically higher payments of a lease over a mortgage and the property's appreciation, among other benefits. The lease term probably would be much longer, 99 years, for instance, than the standard mortgage term, perhaps 25 years, assuring the buyer of a steady income stream. Exercise 9. To identify each of the following financing transactions. 1. Lizumi built a small medical clinic on her own land. After 15 years, Lizumi sold the clinic. She still maintains her practice in the clinic building and plans to do so for many more years. 2. Ray Washington is making monthly payments on the house in which he lives with his son. Ray is buying the house but has never had legal title. 3. Deborah Harold has held legal title to Blackacre for 6 months, since she took possession. She is making monthly payments of principal and interest to the former owner. 4. Juan Aldana, a veteran, pays a lower than market rate of interest on his home loan, which he pays directly to the government agency that funded the loan. The secondary mortgage market. The initial mortgage lender may be the borrower's only source of contact regarding the loan. The borrower may make all mortgage payments to the original lender, and receive periodic statements of interest paid and remaining principal owed from the same source. Yet in today's mortgage marketplace, chances are that the initial lender has sold the promissory note that is the underlying obligation and is only servicing it for someone else. The sale and purchase of such obligations constitutes the secondary mortgage market. Real estate securities are a substantial source of investment opportunities for those who otherwise might seek alternate markets. This section will review the federally originated agencies that dominate the secondary mortgage market and are called government-sponsored enterprises. GSEs. Fannie Mae, formerly the Federal National Mortgage Association, was created in 1938 as a subsidiary of the Reconstruction Finance Corporation. Authorized by the National Housing Act of 1934, the organization was to have been privately backed, but became a government agency when no private enterprise was willing. Don't confuse the secondary mortgage market with secondary financing, which is a second, junior, lien on already mortgaged property. California_E_principles_10E_book.int 288 the 23rd of May 2017 2:30 and 37 seconds p.m. Unit 9 Government Sponsored and Other Financing 289 to back it. Given the continuing financial challenges brought on by the Great Depression, information about Fannie Mae can be found at www.fannie.com/singlefamily. Fannie Mae has a 15-member board of directors. 10 members are elected by shareholders, and 5 members are appointed by the President of the United States. From its original mandate to serve as a secondary market for FHA-insured and VA-guaranteed loans, Fannie Mae's authority has been expanded to take in conventional mortgage loans as well. Fannie Mae currently buys FHA and VA, graduated payment mortgages, adjustable rate mortgages, and conventional fixed-rate first and some qualifying second mortgages on dwellings of 1 to 4 units. A loan that meets Fannie Mae's underwriting criteria and dollar amount is called a conforming loan. Loans purchased by Fannie Mae cannot exceed the limits established each year using the formula prescribed in the Housing and Community Development Act of 1980. For 2017, the limit has been set at $424,100 for a loan on a single-family residence, $208,500 for a second mortgage, $543,000 for a two-family loan, $676,350 for a three-family loan, and $815,650 for a loan secured by a four-family residence. Limits are 50% higher for properties in Alaska, Hawaii, the U.S. Virgin Islands, and Guam. Loan limits for other high-cost areas, including those in California, are $636,150 for a single-family home, $814,500 for a two-family home, $984,525 for a three-family home, and $1,223,475 for a loan secured by a four-family residence. Their increases have enabled many more California homeowners to qualify for a loan within the conforming limit and avoid the increase in interest rates typically paid for a jumbo, non-conforming loan. Fannie Mae calls loans that are over the regular limit, but within the high-cost area limit, jumbo conforming loans. Fannie Mae will buy a block, pool, of mortgages from a lender in exchange for mortgage-backed securities that represent undivided interests in the group of loans. The securities may be sold or kept by the lender. Fannie Mae guarantees payment of all interest and principal to the holder of the securities. In 1968, Fannie Mae was divided into a corporation owned by private shareholders, which retained the original name, and an organization called the Government National Mortgage Association, now called Ginnie Mae, which is discussed below. Fannie Mae now issues its own common stock, and it also obtains capital from borrowing, selling notes and debentures, selling mortgage-backed securities, and money earned from its own mortgage portfolio. Ginnie Mae, created as the Government National Mortgage Association, has brought many investors into the residential mortgage market by offering high-yield, risk-free, guaranteed securities. These securities also have none of the servicing obligations of a regular mortgage loan portfolio. Information about Ginnie Mae can be found at www.ginnie.gov. Unlike Fannie Mae, Ginnie Mae does not buy securities. Instead, Ginnie Mae guarantees securities issued by FHA-approved home mortgage lenders. Ginnie Mae guarantees that the purchaser of privately issued securities backed by a pool of residential mortgages will receive timely payment of interest and principal, less servicing and Ginnie Mae fees. In the event of late payment by the borrower, the securities issuer advances the payment to the securities holder. Ginnie Mae securities are backed by FHA-insured and VA-guaranteed mortgages, as well as those guaranteed by Farmer Mac, including single-family fixed-rate, graduated payment, growing equity, and manufactured home mortgage loans. Freddie Mac, originally the Federal Home Loan Mortgage Corporation, was created in 1970 in direct response to the scarcity of mortgage funds. Freddie Mac provides a secondary market for residential conventional mortgage loans by buying such loans and reselling them to individual investors and financial institutions. Maximum loan amounts are the same as those set for Fannie Mae. Freddie Mac was funded initially by the sale of non-voting common stock to the Federal Home Loan Banks. Freddie Mac now issues preferred stock to the general public. You can learn more about Freddie Mac at its website, www.freddie.com. Since 2009, Freddie Mac has been authorized by the government to conduct a number of programs to ease the home foreclosure crisis. Descriptions of current programs are at www.makinghomeaffordable.gov. The most recent programs include the following: a hardest hit fund, HHF, programs in 18 states, including California, and the District of Columbia were created to assist homeowners through loan modification, mortgage payment assistance, including funding to eliminate second lien loans, and transition to more affordable housing. Some states have already closed program applications. No new applications will be accepted in any jurisdiction after December 31, 2020. The Home Affordable Modification Program, HAMP, provides eligible homeowners the opportunity to modify their mortgages to make them more affordable. Eligible homeowners must live in an owner-occupied principal residence, have a mortgage balance less than $729,750, owe monthly mortgage payments that are not affordable, greater than 31% of the homeowner's income, and demonstrate a financial hardship. This program originally terminated for both Fannie Mae and Freddie Mac loans on December 31, 2012, but was extended for participating non-GSE serviced loans. Application deadline is December 31, 2016. The Home Affordable Foreclosure Alternatives Program, HAFA, which is a part of HAMP, applies to loans not owned or guaranteed by Fannie Mae or Freddie Mac. HAFA provides opportunities for homeowners who can no longer afford to stay in their home, but want to avoid foreclosure. To www.freddiemac.com www.makinghomeaffordablegif California_Re_Principles_10E_UO9.im 290 the 6th of January 2017 1:01 and 33 seconds p.m. Unit 9 Government Sponsored and Other Financing 291 Transition to more affordable housing through a short sale or deed in lieu of foreclosure. Homeowners must submit an application with an executed purchase agreement on or before December 31, 2016. With escrow to close on or before September 30, 2017. The Home Affordable Refinance Program gives homeowners with loans owned or guaranteed by Fannie Mae or Freddie Mac an opportunity to refinance into more affordable monthly payments. This program expires September 30, 2017. Congressional Oversight. The Office of Federal Housing Enterprise Oversight, OFEO, was created by Congress in the Federal Housing Enterprises Financial Safety and Soundness Act of 1992. OFEO was charged with making legislative recommendations that are designed to enhance the financial safety and soundness of Fannie Mae and Freddie Mac. Under the Housing and Economic Recovery Act of 2008, HERA, OFEO was merged with the Federal Housing Finance Board, FHFB, to create the Federal Housing Finance Agency, FHFA. The website of FHFA, www.fha.gov, has a great deal of useful information, including a house price index for all 50 states and the District of Columbia. Electronic signatures. A growing number of loan originations accomplished via the Internet. This trend has undoubtedly benefited from the passage by Congress of the Electronic Signatures in Global and National Commerce Act, which took effect October 1, 2000. Many states, including California, had already adopted the Uniform Electronic Transactions Act. The new federal law gives electronic signatures and records the same legal validity as written contracts and documents in every state. The law makes it possible for a mortgage loan to be applied for, approved, and made without a single piece of paper changing hands. Not every transaction can be carried out electronically. However, the law makes exceptions for certain documents of critical nature, such as court orders, mortgage foreclosures, termination of health insurance, utility cancellations, wills, and adoptions, which will still require written documentation on paper. Federal Housing Finance Agency, FHFA. The effort to ensure stability of the housing market has resulted in stronger federal control over the GSEs. Fannie Mae and Freddie Mac were placed into conservatorship by the Director of the Federal Housing Finance Agency, FHFA, on September 7, 2008, in accordance with the Housing and Economic Recovery Act of 2008. HERA. In an agreement with the U.S. Treasury that was reached in September 2008 and amended in December 2009, the Treasury was to provide Fannie Mae with the capital needed to correct any net worth deficiencies recorded in any quarter through 2012. After 2012, the Treasury's remaining funding commitment would www.fha.gov California_principles_10e_book.inp 291 the 23rd of May 2017 2:30 and 37 seconds p.m. 292 California Real Estate Principles 10th edition B $124.8 billion. Less any positive net worth Fannie Mae may have had as of December 31, 2012. As the housing market has improved, so have the fortunes of Fannie Mae, which has not received funds from the Treasury since the first quarter of 2012. Fannie Mae reported that it would pay taxpayers $2.9 billion in dividends in September 2016. For a total of about $151.4 billion in dividends paid to the Treasury. Nevertheless, proposed legislation may replace Fannie and Freddie with federally insured mortgage securities that would require private insurers to cover initial losses before a government guarantee would kick in. Exercise 9.3 How does a secondary market for real estate mortgage loans benefit borrowers?
Perfect.